Good morning. Our group is presenting a 20-slide analysis of Mr. Saurabh Mukherjee's Unusual Billionaires. We have structured this to move from strategic DNA of greatness into a technical execution of modes and portfolio. As the first speaker, I will cover the first four slides of the PPT, while my teammates will later move on to technicalities of IBS and growth trajectories, etc. I want to start by addressing a very fundamental question. Why do only handful of companies in India stay great even after decades while most of them fade? To understand this, we must first understand the architect of Insight, Mr. Saurabh Mukherjee. As the slide outlines, his background at Ambit Capital and his studies at LSE in economics shaped his philosophy that prioritizes filtering over forecasting. A key insight here is that in a volatile market like India, there is a very unfair advantage is that it isn't about predicting the next big trend. It's about filtering out the most strong companies out of the weak companies. Mukherjee's work from Coffee Can Portfolios and Victory Project consistently argues that time is an ally. If you have discipline of filtering out the clean accounting and capital efficiency, this sets the stage of our growth path. We aren't just looking at survival, looking at winners. This brings us to the second. Let's move on to the second slide. Okay, the second slide talks us about rethinking greatness. We often ask, is the greatness merely a financial performance? Is it a stage in the life cycle or is it contextual? My insight while analyzing this, I realized that greatness isn't just a relative metric. If we look at it from the multi-perspective lens, then greatness can be called as functional, operational, and cultural. Therefore, greatness becomes absolute. It isn't just about having high ROC compared to its peer. It's about absolutely standard of consistency that persists regardless of economic tensions and industry disruption. As the slide notes, greatness often look boring, and that's why most of people miss it. Let's move on to the third slide. Finally, the third slide argues about greatness is a choice, not a formula. This is where DNA meets the execution. A great company exhibits a sustained consistency and prudent capital allocation. But the real discovery here is coherence between intent and action. Companies may temporarily trade their efficiency for capability building, but they never lose the sight of their core business by choosing to deepen the competitive advantage rather than chasing unrelated rather than chasing the unrelated uh, businesses and diverting their focus from their core business. They give a consistent growth. These firm define path our group will now explore. I have laid out why and what of this absolute greatness. Later, our group will discuss about SWOT analysis, IBS, and other performance metrics. Now, I will hand over this floor to Tisha.
Moving on to the next slide. Okay. Now let's start with the foundation, which is focus. So as you can see on your screen, there are three important points. The first one is focusing on core business. Great companies don't do everything. They do few but exceptionally well. They don't get distracted from the shiny objects. The second one is deepening competitive advantage. Every day they try to make their moat wider so that they can stay ahead of their competitors. The third one is controlled capital allocation. The capital is allocated in disciplined way. They invest only where they know they can win. For example, Asian Paints, instead of just making paint, they found a gap which competitors missed. Everybody ignored small town shopkeepers, but Asian Paints went directly to them. And this is how they built an efficient supply chain, which is very hard to replicate. Now, moving on to the next slide, we have competitive advantage. As you can see on your screen, competitive advantage is a unique capability or position that allows a firm to constantly outperform its competitors over a long period of time. As you can see in the Venn diagram, the sweet spot of competitive advantage is the area where your offer meets your customer needs, but your competitor's offer cannot reach it. Few of the examples mentioned by the author in the books are, the first one is Asian Paint using their data analytics to forecast demand before anyone else has done. HDFC Bank was the first bank to launch mobile banking. Astral Policy didn't just sell pipes; they built a whole plumber community, which was the strategy for growth. Page Industry made their own elastic so that they can excel in manufacturing process and quality. Moving on to the next slide. Now, how do we analyze these framework? So there's a IBS framework given by John Case. There are four important components. The first one is innovation. Innovation is not only about creating new product, it is also about process or business model. For example, Axis Bank launching new services. The second one is brand and reputation. It takes a long time for a company to build brand and reputation, but this is an ultimate moat. It includes customer trust, pricing power, and many more. The third one is architecture. This includes the hidden relationships, long-term relationship with employees, distributors, suppliers, like Berger Paint having external loyalty with its distributors and suppliers. The fourth one is strategic asset. It is a unique position or resources which create barrier and entry for your competitors. Just like Asian Paint having high-tech manufacturing plants and supply chain, which is really hard for competitors to replicate it overnight. Now, I would like to hand over this to Kanha.
Thank you, Tisha. Okay, so I will start with innovation. Now, normally, when we hear innovation, we think of something very disruptive, where something very high tech or very dramatic. But in the unusual billionaire, innovation is explained very differently. Here, innovation is basically doing a small thing better again and again. Not one big idea, but continuous improvement. If you look at this slide, words like incremental, efficiency, execution, stability stand out. And that's actually the mindset of these companies. They are experimenting randomly. They are not experimenting randomly. They focus on execution. And over time, these small improvements really add up. Let me explain this using Asian Paints. Asian Paints didn't just win because of branding. What they really did well is supply chain innovation. They invested early in demand forecasting and automation. So they know which product would sell, where it would sell, and in what quantity. This reduced cost and ensured fast delivery. So innovation here was happening behind the scenes, but it created a huge advantage. Now coming to Berger Paints, Berger focused a lot on application level innovation. For example, tinting machines at dealer shop reduced inventory pressure and made color selection easier. That improved efficiency at the dealer level. Marico is another good example. Their innovation was very consumer centric, changing packaging from tins to plastic bottles and uh, launching health variants. Small changes but very effective. Page Industries continuously innovates its fabric quality and fit. That's why customers stay loyal. HDFC Bank's innovation is not very visible. It's in their system and risk processes which help them grow without bad loans. Axis Bank used technology to improve service delivery and Astral Poly. Yes, CPVC pipes were new, but the real innovation was training plumbers so that the product was used correctly. Now moving to the next slide, let's talk about brand. Innovation and brand are actually connected. In the unusual billionaire, Brand does not mean advertising or celebrities. Brand simply means trust. It means when consumer buys something, they are very confident it will perform the same way every single time. Take Asian Paints again. Their brand strength comes from reliability. Same color, same quality, and easy availability. Berger Paints also built its brand by consistently delivering good performances and positioning itself as a premium option. Marico's brand like Parachutes and Saffola are trusted because they stay true to health and quality. Page Industries is very disciplined. They don't chase discounts. They focus on quality and that builds long-term loyalty. HDFC Bank's brand is all about safety and stability. People trust it with their savings. Axis Bank's positioned itself as a modern private bank. Astral's brand is strongest at the plumber level. Word of mouth and performance build trust faster than advertising. So just to wrap this up, innovation improves process, better process creates consistency, consistency builds trust, and trust creates strong brands. That's the main idea behind the unusual billionaire and why these companies continue to dominate. Now I would like to hand over to Miqdad.
Good morning. Good morning. I'm Miqdad and I'll be walking you through the architecture behind the companies. This architecture rests on four pillars: people systems, long-term hiring, strong internal leadership pipelines, and decentralized decisions with central oversight, culture and incentives, rewards tied to ROCE, cash flows, and execution. Reviews are frequent and data-driven. Governance and capital allocations, conservative balance, disciplined capital deployment, and clear minority shareholder alignment, distribution and ecosystem. A long-term partnership with dealers and suppliers enables scale without losing control. A well-driven architecture enables firms to coordinate resources efficiently, make faster decisions, and sustain performance, making it critical source of competitive advantages. Next slide. Strategic assets are valuable resource that competitors cannot easily copy or replace, which creates entry barriers. Now, if you look at individual companies, the moats look very different. Asian Paints' strong operations give it an edge. Its wide dealer network and fast delivery system make products easily available, which is very hard for competitors to copy without increasing their cost. Berger Paints, well-planned factories close to key regions and tight cost control help protect margins while still allowing the companies to move into higher value products. Marico, everyday use products and trusted brand keep customers coming back. This supported by a little asset base, which allows the company to earn higher return with a low capital investment. Next slide, please. The same pattern holds across the remaining companies. Page Industries, exclusivity and tight manufacturing control drive category dominance. HDFC Bank, process excellence, strong underwriting, and low cost deposits compound steadily. Axis Bank, corporate relationships support a cleaner, more profitable retail franchise. And lastly, Astral Poly, early product differentiations and plumber loyalty create specification-led demand. Thank you. Handing over to Hemil.
Thank you, Miqdad. I would like to continue from here. My name is Hemil Jariwala, and I am talking about the topic capital allocation. So, all the companies have done good capital allocation and became and made a growth for their from their own sides. So, I have divided the capital allocation in three parts, that is core reinvestments, dividends and buybacks, and avoid unrelated bets or debt to equity ratio. So let's understand what is core reinvestment. And in this, we have two companies, that is Asian Paint and Page Industry. So let's start with Asian Paints. So Asian Paints has done paint expansion, and they have reinvest their profits in their own business, by which they have made a good growth for a long term. Let's move ahead to Page Industries. As we know, as we know that Jockey has buy its 3-year contract in India, but when it see growth in India, he extend the contract for 15 years, and by that they have captured the manwear in India and became one of the best company in innerwear in India. And after that, they have also started in women's wear too. So let's move ahead to return excess cash, dividend, and buybacks. So as we all know that HDFC is one of the good bank of that time in India. So HDFC Bank has done a good strategy. That is, they have take a deposits as low as at lower cheap rates and give loans to customer at higher rates, by which they can earn a good amount of profit in between, and by which they got more amount of profit from by doing this process. So they have given more amount of returns to their investor. They gave 20 to 25% of profit as a dividend to their investors. Let's move ahead to Marico. Marico has done so many acquisition at a peak time, but some of them has failed, but some of acquisition like Nihar Oil, all these has done a great job and take a company at a good growth. So we can say that Marico has done a good acquisition too. Let's move ahead to last point, that is avoid big unrelated bets that is less than 50% and debt to equity ratio. So Astral Poly, as we know that in book we have seen that Astral Poly has in starting phase they have done so much of losses to grow their business. By doing that, they build their brand, and after that they have trained their own plumbers, by which they get the market share, and by doing that process they have earned the market, and after that they earn profit by that. That's why we can say that Astral Poly has done such a good capital allocation in their company. So let's move ahead to Berger. As we know, Berger has done such a low capex. Then also they have done a good growth in their companies and survive long term process. Let's move ahead to next slide. That is coffee can portfolio. So I have concluded from book that coffee can portfolio can coffee can portfolio versus Sensex. So as we can see that coffee can CCP has outperformed Sensex at every years, but we can see in 2014 and 15 both Sensex and CCP got hit by some market crashes. That's why we need to understand that we need to make changes in our strategies by changing in markets, because markets are not stable, they changes over the times. So we need to make changes to get better returns from our that strategy. Let's move ahead to next slide. So here is a coffee can CCP of CCP versus Nifty from CY 2017 to 24. As we can see in the chart that from CY 17 to CY 20, the CCP has outperformed Nifty, but after that, CY 21 to 24, Nifty has outperformed CCP. This is because we have not made changes in our CCP, because the markets are not stable at all. We need to make changes in our strategies, because market are unpredictable for us too. I would thank you. I would like to go ahead with Farhan.
Thanks, Hemil. Hi, everyone. This is Farhan Amalani, and I'll be showcasing the current CCPs and speaking on the broader management topic. So, as my colleague Hemil showed an excellent slide on the stark out performance of the past CCPs, barring a few caveats here and there. I would like to, the natural question which occurs is what are the current CCPs? So, on the left are the names we have selected using Saurabh sir's twin screening criteria, sales growth of 10% and ROC is about 10%. Now, these numbers aren't arbitrary. The sales growth target is aligned with the long term nominal growth rates for the past 10 years.
And the ROC filter is toned down from our calculated weighted average cost of capital of 13.9% to 10% due to very few results. So as you can see, the list includes names such as Beta Drugs, Bajaj Finserv, Peace Industries, Awas Financials, Five Star Business Finance, etc. Now on the right side, I have allowed a handful of companies where the COVID year is treated as an exception. Businesses where one pandemic year would otherwise distort a multi-year trend. These names include Aditya Vision, Avenue Supermart, Safari Industries, etc. So the logical reasoning behind this was when you're screening over a decade, one outlier year like a COVID shouldn't throw out an otherwise consistent franchise. So we have used this judgment, but conservatively and in a well-documented manner. So the moving on to the next slide. So compounding depends on the people running the business. That's where Saurabh sir's management framework comes in. In this diagram on the left side, I've shown the things visible above the water are operations, marketing, and quarterly execution, etc. Now, these are the things that markets and analysts usually focus on, but the deep submerged traits are the real drivers of durable outperformance. For example, skin in the game. Founders or promoters with meaningful ownership align incentives with minority shareholders. They are incentivized to think long term. Capital discipline. Managements that refuse to chase low return expansion and only reinvest where ROIC exceeds the cost of capital create compounding. Consistency. Repeated, consistent delivery of growth and margins reduces execution risk and negative surprises. Clean accounting. You cannot compound what you can't trust. Simple, conservative accounting avoids value destruction. Long-term mindset. Resisting short-term fixes for structural strength. Now, when these traits exist, the company is far more likely to produce predictable and durable returns, the kind which the markets love. On the right, I have shown some historical CCP kickoff years and outperformance numbers to illustrate the payoff of discovering compounding managements early on. Now, some practical signs to identify these traits would include asking a management, does they have meaningful equity in their ventures? The next one would be to personally track their capital allocation history, the buybacks, the dividend discipline, the acquisition record. Did they allocate only to high return opportunities or just wasteful M&A? Reviewing accounting footnotes and related party transactions for cleanliness of accounting, looking for operational consistency, same playbook scaled sensibly rather than constantly changing strategy. The next thing would be to look out the management language in con calls for identifying whether they are speaking on the long-term product roadmap or just quarterly shortcut narratives. Moving on to the next slide. Saurabh sir categorizes management into different archetypes, and each can produce winners, but they succeed in very different ways and requires different investor mindset. The first one, owner promoter. High promoter holding, founder in executive role, and reluctance to dilute capital are the key traits. When paired with capital allocation discipline, these franchises create durable companies. Examples on the slide include companies like Page Industries and Marico, where founder-owner stewardship and franchise durability matter. The next one is professional CEO. Here, incentives and ownership are structured for performance. These managements can scale rapidly when governance and incentives align. Think of banks where a professional CEO combined with strong governance can create an enormous franchise. For example, Axis Bank, HDFC Bank, etc. The next one would be distributor controller type of business. Companies with distribution modes such as exclusive dealer networks, logistics mastery, tight trade terms, and these translate operational excellence into durable returns. Asian Paints is a classic example of distribution and dealer play. Next would be capital allocator. These are managements who reinvest only when ROIC exceeds weighted average cost of capital and otherwise return cash back to shareholders. Steady compounding comes from higher returns or reinvested capital. Examples include Berger and Astral, businesses where reinvestment discipline yields compounding. Now, a lot of these great businesses usually have more than one trades, meaning a owner promoter business might have a strong distributor and controller network as well. Now, some of the practical ways to assess each of these businesses include an owner promoter business with clean accounting is usually a lower monitoring cost investment, but succession risk is a key matter to check into. Another would be a professional CEO needs strong governance safeguards, good boards, and transparent incentives. A distributor controller needs to show defensible distribution economics and margin stability. A capital allocator must have demonstrated an ability to find high return reinvestment opportunities or return cash via buybacks or dividends. Though the process of finding a CCB might look very theoretical, management is the key driving factor of these consistently compounding stories. Now I hand it over to my colleague.
Hi everyone. Thank you, Farhan. I'm Jalaj and I'll be talking about SWOT. SWOT helps us analyze the internal and external factors of a business. Internal factors includes strength and weakness, whereas the external factors include opportunities and threats. Let's delve further into each of them. Moving to the next slide, professional management. Top-notch board of directors with vast knowledge help to overcome complex situations as mentioned in Marico. Focus on core business. Company like Asian Paints refrained from any major unrelated diversification, which made it an industry leader. Technology. In the modern world, a strong IT setup can turn out to be the backbone of the business. The same was recognized by the promoters and management of Asian Paints, Marico, and Axis Bank. Whether for supply chain management, whether for SKU, or connecting all the branches countrywide. Let's come to the weakness. Product differentiation. Due to the limited scope of product differentiation in business like Berger Paints, competitive pressure in the industry was high. Supply constraint. At one stage, Asian Paints was not able to meet on time demand on time, which led to some lost sales. A weakness that management openly acknowledged and corrected. Dependency. Page Industries is entirely dependent on Jockey USA, as we all know. Any differences in future could lead to disruption in business process. Similarly, Marico was dependent on Parachute in the early phase before the war with HUL. Now the opportunities. Low cost interest free capital. For for early check clearance, HDFC Bank introduced novel check settlement through which cooperative banks can settle the check with local branch of HDFC Bank by keeping interest-free deposit with HDFC Bank, which enabled HDFC Bank to get free money. Execution strength. Some companies like Asian Paints convert execution strength into market share opportunities, especially when other peer companies making mistakes by doing unrelated diversifications. Brand recall. Astral's growing brand strength allowed it to drive harder bargains with its dealers, resulted in lower debtor days. Now, threat. Poor capital allocation. Berger faced the consequences of capital misallocation. Similarly, Astral also faced the consequences of aggressive overseas acquisition. Economic downturn. Though Axis Bank was able to build similar loan book to HDFC Bank and ICICI Bank, but unfortunately their NPA ratio was significantly high, which could be a major threat in case of economic downturn. Foreign exchange, as most of the businesses are going global in today's market. It can be a major threat to the organization's revenue if its foreign currency exposure is not hedged, as it was in case of Astral Poly. With this, we conclude our presentation. Thank you for your time and attention.